Hi, this is Adam Khoo here. So we're midway to the year 2018. So I'm going to do a half year market review, market analysis, and to see where we are right now, where we've been, and where we're headed. All right. So if you've been reading the news, there's been a lot of bearish news out there, especially the trade war that the US has started. China is retaliating. The EU is retaliating. Brexit is happening. So there's been tremendous volatility in the markets, a lot of fear and a lot of volatility basically. So the question is, where's the market right now? Are we still on an uptrend? Do we look like we are going to continue moving up for the rest of the year? What are the things to look out for? So let's begin with the US market. Now the US market has been the most resilient market among all the markets, among European markets, among Asian markets. Despite all the volatility, the S&P 500 is still on a pretty clear uptrend. So let's take a look at, first of all, the longer term chart. If you take a look at, say, the last 5 years, okay, so this is a 5-year chart of the S&P. We are right now on the 9th year of the bull run, okay, and if you take a look at, for example, this period over here, the market was on a very, very clear uptrend. So at this point of time, it was really easy to make money as a trader. A blind one-legged squirrel could make money. So basically just buy the dips, and the price would go up and you make money very easily because the trend was very, very clear over here. Now you can see this period over here, which was starting from the beginning of this year, the market has been very, very choppy, right? More or less, going in a really big sideways range here. So it's been really tough in swing trading, especially, or even in trend following. We find that the price goes up a bit, comes down, hits your stop loss, you make a bit of money, you lose a bit of money. So it's been quite frustrating as a swing trader or as a trend follower. And that's why most of the money has been made really in intraday trading during this period, where you go in and out within that day, using 1-minute candles, scalping the market. So I've been really focusing more on the intraday trading during this period of time, as well as trading currencies that are more intraday. Because for the swing trading and trend following, yes, it's still profitable, but it's a lot more challenging because you can see that the market has not been on a very smooth uptrend. It's been very, very choppy for the beginning part of the year, right? Simply because of a lot of the events that are taking place, the trade wars, Brexit, and so on and so forth. Early in the year, it was the North Korean crisis, which seemed to have been resolved, at least temporarily, right? Now, despite all this erratic volatility, you can see that the US market is still really strong as of now. We are still on a very clear uptrend. As you know, the way I define an uptrend, or rather a medium-term uptrend, is when the 50 moving average is above the 150 moving average. And if the price is above the 200 moving average and moving averages are sloping up. A bear market is defined when the 50 moving average crosses below the 150 moving average and both moving averages are flattened or sloping down. That's a confirmed downtrend or confirmed bear market, right? And we have not had that yet, at least for now. So you can see that this was the first big sell-off that we had at the beginning of the year. The 50 remained above the 150, no worries about that. It found strong support at 200. So the 200 moving average has been a very strong support, and that's when I started to buy. Every time it hit the 200, I would buy. I'll make a bit of money, and then boom, it come down again. I'll buy, make a bit of money, come down again, make a bit of money, come down again. So again, making a bit of money here and there, but we don't have a very strong follow-through trend because of, again, of this very choppy action. Okay, and then again, because of the trade wars, again, recently we had a bit of a sell-off over here. Okay, now, although the 50 crossed below the 150 over here, that was not a bear market signal. Why? Because the 150 is still sloping up. Remember that both moving averages have to flatten or slope down to confirm a bear market. So this was not a bear market. This was merely just a 50 crossing below the 150, but the trend was still up. And sure enough, it bounced and it's up. After the recent sell-off we had the last few days, again, the 50 is still above the 150. We are still sloping up. We are still above the 200. So the 200 moving average is the level to watch. As long as the price remains above the 200 and the 200 is sloping up, as long as the 50 remains above the 150 and they are not sloping down, the uptrend is clear. So as far as the US market is concerned, it's still a clear uptrend. However, very, very high volatility, a very choppy market, really hard to follow trends, but we're still in an uptrend nonetheless on the US markets. Okay, so won't be surprised if we do still end up the year higher from where we are as far as the US markets are concerned. Now let's break it down to specific sectors. If you take a look at specific sectors, you can see that basic materials have been very choppy. Conglomerates have actually been on a very strong trend. Consumer goods have been basically on a downtrend. Okay, financials have also been on a downtrend after a very strong rally at the last year because of the increasing interest rates. Basically, it started to go bearish over here. Healthcare is kind of like been going sideways, but has been strengthening in the last 2 months. Industrials have been on a downtrend. Services have been strong on an uptrend. And technology has also been on an uptrend, although there's been a strong sell-off the last month. But technically, it's still on a very strong uptrend. Facebook, Alphabet, which is Google, Amazon, Apple, they're still really, really strong in this market. Utilities has been more or less flat, but has bottomed out. So I'll say that in the overall market, the strong sectors to really focus on are conglomerate sectors, healthcare, services, and as well as technology. Okay. Now, I've said at the beginning of the year that I was mildly bullish on the US market because it was on an uptrend, and I still am because it is still on an uptrend until the market proves me wrong. Remember that no one can predict the future. We have got no idea where the market will be in the future. All we can do is to identify where's the trend now and follow the trend. Just follow the trend. On an uptrend, we stay long. On a downtrend, we start to go short or we exit our long position. So as of now, for the US market, we're still on an uptrend. We can still stay long as far as the medium term trend is concerned. Wrong chart, that was mine. But as far as the short-term trend is concerned, we're currently trading below the 20 and 40 exponential moving average. So for short-term trades, I'm a bit weary. I like the S&P to get back above the 20 exponential moving average so that we're short-term bullish to take more short-term long trades. All right. So for the short term, I'll wait for a while, but for the medium term, we're still on an uptrend as far as it's concerned. Okay. Now, if we take a look at, let me just show you a few things over here. Now, I said at the beginning of the year, I was mildly bullish on the US markets because US markets are on an uptrend, but valuation is starting to get a bit high, right? The markets are not cheap. In fact, they are a bit overvalued, but not extremely overvalued. If you look at S&P 500, the current price to earnings ratio, P ratio, is 21 on the S&P 500. So what does that mean? What does a 21 P ratio mean? Well, if you look at the P ratio of the S&P 500 for the last 136 years, you can see that the mean P ratio is 15, the low is about 5, and the high is about 30. So what that means is that when the P ratio is at 30, the markets are at the top of the cycle, right? It's likely to, burst and come all the way down because markets have got boom and bust, right? When the P ratio is at 5, markets are at the bottom of the cycle. That's during a recession. At the bottom of the recession, this is the top of the economic boom. So 15 is the center. So right now we are at 21. We are at 21 right now. So what does 21 mean? 21 means that we are above fair value, which is 15. We are not cheap, but neither are we really expensive at 30 or at about 20, 29 to 30, right? So I still see that the market can still go up for a couple of months or even a year before it hits the top, before it collapses to the next bear market. You'll see the market drop for next 20 to 30 to 50%. Again, no one can predict exactly when it's going to happen. Neither can I. But what I'm doing is I'm watching the trend of the S&P. So the moment the 50 moving average crosses below the 150, and they both start sloping down, that's a confirmed bear market. That's when as a long-term investor, well, as a long-term investor, you could hold, but at the same time, you could use put options, you could buy inverse ETFs to profit as the market collapses, to hedge your long positions, or simply exit all your long positions and go short on the market. So when that happens, basically I'll update you guys, my students, on what to do when that happens. Right, so that's the US market. So again, I said, the US market has been the most resilient market in the face of all these trade wars. And I was actually very bullish on Asian markets at the beginning of the year. Specifically, I was very bullish on China, on Hong Kong, on Vietnam, which I mentioned at the beginning of the year. And the reason I was very bullish was because those markets were on a very strong uptrend, and those markets are actually very, very cheap in terms of valuation is concerned from a investor's perspective. So let me just pull up this for a while. Okay, so if you take a look at China, I'm just going to scroll to China over here. Specifically, let's look at Hong Kong, which is the Hang Seng Index, which to me, the best China companies are listed on Hong Kong. If you look at the Hong Kong market, the PE ratio is 11. It's 11. That's dirt cheap. It's really, really undervalued because, again, the mean for Hong Kong should be like 18 PE. That's the mean average for Hong Kong. If you look at Shanghai, the PE ratio for Shanghai is currently at, internet's a bit slow. Yeah, it's not loading for some reason. But again, Shanghai, the PE ratio is something like about 11 as well. So what does an 11 PE on Shanghai mean? Well, if you take a look at the Shanghai index, if I can just, let me just scroll back to, now this chart is not really that updated, but it's just to show you that now the US is growing at 2 to 3% GDP a year. Shanghai, China is growing at 6, 7, 8% a year GDP. So you expect it to have a higher P ratio because of its higher growth of the market. Okay? So think about it. China's P ratio should average between 30 to 40 PE. That's the mean average. That means the market is fairly priced. And when the market goes to an 80 PE ratio, it's overvalued. When it goes to a 20 PE ratio, it's undervalued, right? Now, to put it in perspective, now, the China market currently, like I mentioned, again, it can't really load that one, but again, I can show you that the Hong Kong one, it's 11. And 11 P ratio, it's really, really cheap. So that's why I was very bullish on the market. I said, from a long-term perspective, I would buy China, I would buy Hong Kong, I would buy many of the Asian markets. But markets are irrational in the short term. So again, cheap can get cheaper, low can get lower. Why? Because of emotions. And what's happened is because of the trade wars, the Hong Kong market, from an uptrend, let me just show you the chart over here. As you can see, it was on a strong uptrend over here, right? It has now broken this support level, right? So support, support, support. It's broken the support and it's now on a downtrend. Okay? So the question is, what do you do? Well, it really depends. If you're a long-term investor in China, like I've got a portfolio where I'm doing long-term investments, I'm holding it for many, many years. And so I have bought quite a bit of China, Hong Kong ETFs. And for that portfolio, you know what I'm doing? I'm just holding it. That's it. I'm not selling, I'm holding it because in the long run, I know it's going to go a lot higher. But in the meantime, I'm not buying more because, again, on a downtrend, I do not want to ever add to my positions because, again, on a downtrend, low can get lower, cheap can get cheaper. You don't know how low it can go. I'll only start to buy again when I see a support level that is reached or when it starts to reverse back into an uptrend. So for now, although China is really cheap, I will not add to my positions. I'm going to see how low it can go because markets can be terribly irrational in the short term, right? And if we take a look at this chart, Currently, it could find support there. So this is a potential level of support. This was previous resistance, turn support. So this could be a potential support. So if this level holds and it can bounce off this level, I'll start to add to my Hang Seng ETF positions or my Shanghai ETF positions. So I'm waiting and I'm watching, but not just yet because it could break the support and then it could go a lot lower. So we'll see what happens to Hong Kong. All right, so again, trade wars, China's going down. Now, I'm from Singapore, so I know a lot of my students are from Singapore, so I'm going to talk about Singapore as well, although I don't invest in Singapore at all, right? Because I think Singapore, the growth rates are too low and it's just too volatile for me to invest in. It's too volatile, right? And again, you can see Singapore, again, you can see there's a strong trend. It found support at the 50 moving average, sorry, the 150, the 150, the 150, it broke the 150. So if you had been long on Singapore, that would have been a sell signal to start to exit the position because now it's trending down. And again, if you're investing in Singapore, you won't add to the positions. Wait for it to reach a bottom. You never know how low it's going to go. All right. So to summarize, Asia's on a downtrend. It's cheap, but it could get cheaper. I will not add to positions. The US is slightly expensive on an uptrend. I'm still bullish on that market for now, right? Finally, let me just take a quick stab at Bitcoin because a couple of you here look at Bitcoin. And Bitcoin, I've already mentioned that it's been on a very strong downtrend since the beginning of March or April, right? So you can see Bitcoin was on a strong uptrend over there, right? And over here, you can see this was the death cross, the 50 cross below the 150 moving average. The 150 is sloping down, the 50 is sloping down, the 200 is sloping down. That was the last level of defense. It's broken everything. So Bitcoin from a high of 22,000, sorry, 20,000 is now at 6,000, okay? And currently, it's now at its previous low over here, right? This was the previous low on Bitcoin. So it's holding that low. Now, if it holds that low and bounces back up, if the 20 crosses above the 40 EMA, short-term uptrend, could take a small long position, okay? And it has to cross back above the 50 moving average, above the 200 to confirm the new uptrend. For now, it's on a downtrend at the support level. If it breaks this support, then goodbye, right? It could fall all the way to 2,000, maybe $1,000 on Bitcoin. So again, you never know how low it can go. I've exited all my positions. At the beginning of the year, I said that you go to 25,000, but like I keep saying, no one can predict the future, right? So I make predictions, but I never follow my predictions. I follow the chart patterns, I follow technical analysis, I follow fundamental analysis in my entry and exit signal. So although I may predict that it goes a certain way, but the moment the charts prove me wrong, the moment the price action tells me, hey, it's no longer on an uptrend, it's a downtrend, get out, I'll get out my position. I never argue with the markets, right? But I'm ready to get back in once the trend reverses back up. So will it still reach 25,000 by the end of the year? Who knows? It may still do so, but for now it's on a downtrend. You should not be holding any long positions on Bitcoin. It's on a very, very clear downtrend. You never know how low it can really go, guys. Okay. All right. So that's my basic quick analysis on the markets. Okay. Yeah, some of you are asking about Malaysia. Yeah, I don't invest in Malaysia myself, but I've got a lot of Malaysian students. So, okay, fine. Let me just take a look at the charts of KLCI. And one of the reasons I do not trade Singapore, Malaysia is because I find the trends are too erratic to trade. They're very, very erratic, very hard to trade. They don't respect the moving averages as well. So that's why I tend to stick to the US markets, which are a lot easier to trade. Let me see, where's the index? Okay, yeah, all right. That looks horrible, man. Whoa, yeah. Boom! You can see. Yeah, so Malaysia's on a very, very strong downtrend. In fact, it's parabolic. Okay, I wouldn't touch it with a 10-foot pole. So just beware. Don't go long. You never know how low it can go. All right, so that's our half-year market review, market analysis, if you will. Again, trend following, swing trading has been really, really challenging. That's why I've been personally focusing on intraday trading, scalping the stock market as well as the forex markets. Trend following will come back, just got to be patient, wait for them to emerge. But if you're a long-term investor, if you're a long-term investor, if you've got a long-term investment portfolio like I do have, this is a great time to buy great companies at huge discounts, especially in Hong Kong and China. But again, wait for a base to be reached, wait for some reversal. Don't buy while it's falling. Don't catch a falling knife. Right? So Adam Khoo here. You got questions? Send me an email. I look forward to seeing you guys soon. Thank you.